Most investments carry risk, but there's one that is all upside. The only risk-free investment is an investment in yourself. The Globe and Mail is the largest business newsroom in Canada, interpreting and unpacking macroeconomics, housing, policy decisions, and world events. Enjoy a comprehensive suite of business newsletters, breaking news, and market updates straight to your inbox. As a subscriber to the Globe and Mail, you'll get access to investor tools like advanced charting, portfolio with the Wealth Scope report card, providing an independent 6-factor review of your portfolio, and stock screener to help you find the right investments. The Globe and Mail is offering a special digital subscription rate just for Loonie Hour listeners. For a limited time, get access for $75 a year for your first year. For more details, visit globeandmail.com/podcast.
Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 77. As always, joined by the three amigos. We got Keith Dicker, IceCap Asset Management, and Rich Diaz of Acorn Macro Consulting. Rich, back in his orange shirt, back in London. What's going on?
Back in London, recovering from a 2-day hangover, but no, it's good. It's actually sunny. Daylight savings time is over. It's the best time of the year in London. It's time for beer gardens, and the football's heating up. And yeah, lots to talk about. It's good. And yeah, it's fun.
You're always hungover,
well. I am a little bit always hungover. Wednesday's the new Thursday, right?
Keith?
It's same thing. I'm just happy when Rich is happy. That makes this podcast flow so much better.
Yeah, thank you.
Like over here in the Maritimes, we're getting ready for spring. You can feel it outside. It's coming, and this year we'll have the second annual IceCap Beer Garden get together. We'll try to.
Whoa, Rich!
Yeah.
I didn't get my invite. Did you?
No, I did not get my invite.
Jeez.
Well,
It's been lost in the mail again. Canada Post. All these budget cuts.
We're going to try to improve our numbers from last year, which I think we had 4 people. So maybe we'll double it to 8. Yeah, no, it was fun. But anyway, yeah.
Fun tip for the listeners. Keith has quite the wine palate. Big Pinot Noir guy. If you're ever going to send him a bottle. I told him what I drink. He almost puked.
By the way, everyone, that's not necessary, but we can absolutely share some wine or a pint or something. So anything happening this week in your neck of the woods, Steve?
Well, yeah, I mean, we can start things off on the real estate front. It's been busy. It's crazy. I don't know what to tell you. Like, banking crises be damned. Canadians aren't thinking about those. They're out there buying housing right now. And so, yeah, I've been surprised around the resiliency. I think that what we're seeing, we've talked about it on the show, 20-year lows nationally in new listings. Very difficult to have a bear market when you've got no inventory. So, yeah, we're just seeing people out there, predominantly like young families, people that are just ready to move, wanting to move, and multiple offers on pretty much any entry-level house. Entry-level product in general is just very active. Things are selling like hotcakes. Because again, I think the biggest thing here is not that there's just like this insatiable demand that like people are falling head over heels, but there's really no inventory. And so you get a decent listing that comes to market, you're almost certainly competing. So I mean, it's kind of interesting I can tell you for sure that prices are up this year. They're up from last year, especially towards the end of last year when we had really, I think, the depths of the housing bear market. And so maybe, I don't know if that complicates the path forward for the Bank of Canada, but housing is doing just fine. At least for now.
It's almost as if housing bottomed 2 to 3 months ago.
I told you,
you beat
were
me
warned.
to it.
You were warned. No, I mean, like, don't get me wrong. I mean, like, I still think there's risks out there, right? I mean, as we're going to get into in the show. But as it stands, the inventory levels where they are.
Listeners, everyone listening, that's called the hedge, by the way.
Yeah. I don't think it's the time to, be risk off and plowing huge amounts into the market. I mean, I think, hey, if you got to buy a house to live with your family, you'd be there for the next 10 years, probably not going to make a big difference. But I'm still pretty cautious. I think there's still product out there that's kind of struggling. But to that point, actually, I'll bring up on the show a little bit of news. We did have an announcement from the federal government regarding the foreign buyer ban. So you'll remember on the Trudeau government, which basically said, you're xenophobic if you were against foreign buyers. Then later, came out with a foreign buyer ban last year. So there's a 2 year ban on residential purchases. Now,
non-residential purchases.
No, residential.
Oh, okay.
Right. So if you wanted to buy a residential property, you were not, if you're a foreigner, you're not allowed to buy residential for 2 years. So 2 year ban.
Got it. Sorry.
And, again, classic government, just not very well thought out policy. Like they don't really consult people in the industry. They just implement policy. So, you immigrate 1 million people into the country. More than half of those were non-permanent residents, which is basically foreign students, temporary workers. So you're asking people to come here and work in this country to shore up some of the labor issues. And then you're telling them, well, you can't buy housing. You need to go and rent. So, and the rental market's horrible, as anyone can attest to. And so there was all this blowback, I guess. And so basically they've come out and they've said, okay, we're going to make an exemption now that if you are here on a work visa and you are applying for PR, you can purchase one residential property in Canada. So that's an exemption. People are all upset on Twitter about it, saying, oh, this ban has no teeth. So that was number one. And then number two, which is, again, not well thought out policy, was you have a local developer. Let's say you have a local developer in Vancouver. A lot of the times that developer will have capital partners, right? I mean, these are hundreds of millions of dollar high-rise projects. So they'll have capital partners. And let's say, 5% of their company is American. Under that circumstance, they are not allowed to acquire land for the purpose of developing new construction.
What? So you can't use foreign capital to build properties in
Canada?
Right,
because the corporate structure, right? You look at the corporate structure, it says, well, hold on a minute. 5% of the people that are involved in this corporate structure are non-Canadian.
Domicile. Yeah, they're non-domicile.
So they are considered foreign buyers, basically. And so I think the threshold was like, if you had, I think, more than 3% of your basically development company or whatever was non-Canadian, you were not allowed to buy residential real estate. So you have to think about it, like most of the land that developers will buy initially will be zoned residential. It then goes through a rezoning process, which allows it to sort of become multifamily, and it gets built into condos, right?
Wait, sorry, this is bananas. My brain, this is so stupid that I don't understand. So if you're, let's say, a UK investor, let's say a pension fund, and you've allocated, 5% of that of your pension money to buying real estate, commercial real estate, let's say, or residential properties to rent, and that population growth in Canada is high, and you want to invest in that market, and then you go to Halifax, which has a shortage of housing, and you say, I want to buy this stuff, and I want to invest money from my country to your country, Canada. You're not allowed to do that?
Correct. Yes.
What the?
So basically, again, we immigrated 1 million people in 2022. And we're desperately short of housing supply. And so to the government's infinite wisdom, they've now reversed a lot of that policy. So I think they changed the threshold from 3% to 10%, basically. So okay. I know friends that are local Vancouver developers, and they're like, oh my God, like we were like, basically we could not acquire new land to build. And these guys built rental housing. They built purpose-built rental housing in BC. but they were not allowed to actually go out and acquire land because the government's foreign buyer ban exempted them. So anyways, so those are the changes. If anyone's looking for clarification, if you're just reading the media headlines that shows, hey, government's easing up on these bans, please dig a little further. I think they're actually appropriate changes.
So is there I mean, as complicated as it is, and the world is incredibly dynamic. I mean, I think, that's a good example of why it is. Like, Steve, is there some kind of a government policy solution for this, or should it just be left to, the private, open market, let the private markets sort it out? Does that make sense? Do you know what I mean?
I mean, I think obviously, you're preaching at the choir here. I'm a free market guy. So, I think that I've heard people like make the arguments that, developers are bad people. We need to get housing into government needs to buy and build and control housing. And again, if you're asking government to build housing, I can only imagine how over budget and how delayed a project would be under government control. So yeah, I think like ultimately the problem is in Canada is really, I think the permitting process, there's just so many layers of bureaucratic mess that to get through that hurdle is just, it's a disaster. And so it takes way too long to get projects approved. And when you pull in 1 million people a year, it's hard to keep up.
But wait a second. The answer to me seems like an all of the above approach. Like, Andrew, who was our guest last week. Thank you, Andrew. Who came on, he mentioned what was going on in New Zealand. And in New Zealand, they've just put the hammer down on planning laws and really have tried to, from a top-down approach, reduce the amount of time it takes to get permits and zoning rezoning rules and blah, blah, blah. And that's been an obviously decent approach to New Zealand's housing crisis. They have a similar situation as we do in Canada. But then there's also, in the past, governments have built an incredible amount of low cost housing. Seems like, why not? They own the land. Why should we hand the margin over to people who will inevitably be, let's say, politically connected to those people? We might, because I can assure you that that's what would happen. And so there's that angle. But then there's also just in general, just reducing broad strokes red tape and letting suppliers just get after it, and even providing tax rates. It seems like all of the above approach seems the best one.
Yeah. So to your point, and Andrew mentioned this as well, but yeah. So basically, New Zealand, I can't remember which part of New Zealand it was.
Anyways. There's only like 5 cities.
Yeah,
it's definitely the North Island. It's not the South Island. It's just
exactly.
It was like one of the big main parts of New Zealand. Basically, they actually, I think they outlawed or basically banned single family zoning. So they just said like everything has to be like, I don't know what it was, minimum duplex or triplex and up. So like you're not allowed to build single family housing anymore. Yeah, obviously, if you look at the construction charts now in New Zealand and in that segment, like construction is blowing out. So people are obviously taking the reins there, and the free market is doing what it would do. And so, yeah, I look at like Vancouver, I think it's like just the city of Vancouver in the core. It's well over 50% of the actual land is zoned single family, which is pretty crazy. Because when you think about it, like for a very small lot, single family lot anywhere in Vancouver, let's go with the east side, like you're starting at like 1.7 just for the land, just for the dirt, like for a tear down house. So like, it's really not accessible to a lot of people. So should they be doing blanket rezoning? I would argue that makes sense, but I just think the politics get in the way of that.
Well, can I ask you one more question? So like to what degree, I know you can't put like a percentage on it, but like to what degree is this just like classic NIMBYism, that no matter, even if you had the best government in the world or no government in the world, NIMBY, like not in my backyard, where it's just like at the very local level, people are just not willing to accept that councils or local like municipalities or whatever change a zoning from single family to multifamily. Like, I mean, you must see
crazy.
it all the time, right?
No,
They
it's
must be crazy, right? Like,
it's
and
wild.
I'm not talking about building a 20-story residential tower next to a single family. I'm saying going from 1 to 3 or 2, because in Montreal, where my mother lives, out in north part of the city, it's all these duplexes. So triplexes, duplexes, right? And you have 4 or 5 relatively small apartments, but kind of nice in a nice neighborhood or whatever in this one lot. And tell me about, you must know some crazy stories, right?
Oh, I mean, just go to like anyone, like I think they're all like publicly available, but like you can just go to like any like they call them like readings. Basically, it's like the city councilors get together and then they send out these flyers in the mail and they tell people to show up to come voice their opinions. So you get all these like neighbors that are like, well, I don't want that in my backyard. And so just like the comments. And so what happens is like for like to get a project like rezoned and approved, like you might have to go through like 3 or 4 readings in Vancouver. So it's like a multi-year process. And like every time you got to go back and hear the neighbors' complaints, you have to like tweak like your building. Then you come back with a revision, they complain again. It's just honestly like to be a developer in like most of Canada is a complete gong show. But that's just like emblematic, I think, of this country, which is like heavily regulated, lots of government, like that's Canada. And so that applies to the housing front, really. So I mean, I'm sure
I think that's the same. I agree with you, and it's the same. I mean, like I live in a nice neighborhood, and do I want an 8-unit building going up next to me? Like, no, of course I don't.
Classic boomer, eh?
Yeah.
No, I mean, I get it though. I do get it. I mean,
like it's a similar, like another perspective on it, but like all this climate change euphoria that's out there, they're all preaching, and how do they arrive at their global meetings? They're on the private jets. Do you know what I mean? So it's, everybody wants affordable housing and a clean environment and stuff like that. But when it comes to making that personal sacrifice, it's tough. And I'm sure the whole development industry, and I'm sure it's not just in housing, I'm sure you'll find it in other markets as well. But maybe though it is best if it is left to the private market. Because right now, I mean, we're in this incredibly tight market, and we're being overwhelmed with population growth. I mean, overwhelmed in a relative sense. That is, the number is a lot bigger than it used to be. But if things are not great here for people immigrating, then they'll stop coming. Like they'll go somewhere else, and then things will work its way out. Or maybe we'll get another new government coming in because they have a financial budget coming out that may not be that.
Yeah, let's leave the housing frontier for now and jump over to the budget, because I think that was pretty important. We got a lot of feedback from our listeners just asking us to cover it. So we'll try to keep our political views out of this as best as possible. But Canada's federal budget, so they added 43 billion in net new costs over 6 years, even as the government projects about 34 billion less in revenue compared with forecasts earlier in November. The end result is a significantly higher deficit each year through 2028. And then just to kind of add to that, so total gross new spending is about 67 billion over 5 years. So that net that they kind of noted earlier basically hides, it's hidden through new tax increases. And so like tax increases are basically tax revenues, Keith, is certainly up for debate, because we were chatting about it off air, which is the government really never forecasts downturns and a reduction in capital markets. Obviously real estate, if real estate goes through a bear market or a prolonged bear market, the amount of tax revenues coming in the door are significantly going to hamper that deficit.
Yeah, I mean, there's a couple of things with that. So first of all, you guys remember the first Jurassic Park movie that came out?
Yes, of course.
Yeah,
Great one.
Yeah. That was, actually that's where the Toronto Raptors got their name, because back then all of a sudden dinosaurs are cool. Everyone was trying to capture that.
This is a true
And
story. Fact.
It is
Confirmed.
fact. Yeah, it is. Like, how many dinosaurs are in Toronto? It rhymes like that.
Well, Canada has a long storied history of Jurassic digging and archaeological finds. But anyway, keep going.
Climate change killed the dinosaurs.
Oh my. Anyhow, anyway, in that movie, Jeff Goldblum had a really great quote I thought would apply to the budget. And remember, he's looking at the big pile of dinosaur dump. Do you remember that? Like, he was like 2 stories high. And I think it applies to the budget. He said, man, that's one big pile of shit. So I think that's why
That's
Oh,
your
man.
quote. Oh my God.
yeah, this is a tough one. This is a really tough budget. So carrying on from what Steve's perspective, just to open up the conversation, how like going into the future, what the deficit will look like and tax revenues and stuff like that. So 2 points. First of all, this happens all the time. So every single budget comes out, and every year the I think it's the CBO. What is the CBO? Or is that down the US?
The Congressional Budget Office, that's the US.
That's the American. So the Canadian equivalent, they'll come up with their estimates going out and stuff like that. Their long-term projections, they're going to make it look as best as they can. That's like, they're not going to show a big pile of crap, right? They want to make it look as great as it can. And even with this budget, as best as they can make it look longer term, it's a tough one to swallow, guys. It's a real tough one to swallow. So we will jump into it, but that's the initial, thought behind it. And we're also going to overlay with this for everyone what the market reaction could potentially be, and more importantly, what could happen to really cause these projections to go off. Because if they go off, then we do end up paying for it. So we end up paying for either through higher taxes, less services or no services, a weaker dollar, higher financing from the yield curve. Like, you're attracting, you're not able to attract high quality immigration coming in, or at the university level, or innovative companies. Like, there's so many potential pitfalls coming up here if we don't hit this perfect glide that we're looking coming up. What do you think, Rich? Rich has his orange shirt on today, so we know how he feels.
Oh, right. No. Although I do like Jack Layton. But anyways, I think for me, my politics are probably quite obvious, but I think for me, it's always about, I always have technical nitpicks. The forecasts, like as Keith said, are often always rosy. Just a couple of things that I kind of find annoying, which is like the expectations on inflation, which are basically just under 2. That's no coincidence. Productivity
that was their
growth.
projection.
Yeah, I'm looking at it right now on table A1.1.
For how many years?
Well, it's just 2. It's like, 8, 1.8, 1.8, 1.9, 1.9. I mean,
Goldilocks,
baby.
baby.
It's bogus. Of course, they'll argue that they've surveyed, 13 of the best 5,000 economists, and they're never going to. I mean, it's in some ways we have to be a little bit more cynical. They're not going to propose something that I think is like outrageous. They're never going to make a call on these economic stuff. But I think it's a bit insulting for someone like me who's a bit sensitive about these kinds of things. I just think it's bogus. I think the productivity growth stuff I just think is abysmal. Canada has a horrible record on investing in research and development because we hate the oil sector. We have the worst productivity growth in the OECD. One of my big kind of bugbears is they constantly insist on comparing Canada to G7 countries, which I think is just a complete basic lie, because included in that is Italy, that's just not growing, hasn't grown for years. Japan is an economy that has a population growth that is the same level as it was 24 years ago. You have and then you have France and Germany, which are just wildly different economies structurally, population growth, age, blah blah blah. Canada should be comparing itself to us. Yep.
Rich, the data from those countries is kind of like make believe, like, isn't it?
Right. But yeah, exactly. Sure. But Canada is a younger country. It's the new world. It's a commodity driven economy. It should be comparing itself to much more specific economies. And so what they do is they use that in order to basically paper over all these shitty numbers. So that's another bugbear I have. One thing I thought, I mean, I'm going to try to stay relatively even keel. One thing that I thought was really interesting is they directly address supply chain issues with respect to China and rare earth metals. This is now the second budget in a row that they've done this. They talk about lithium, nickel, cobalt, graphite, whatever. They have a whole section on that. And they say we need to move away from the supply chain and only being China, which is, I think, probably, you know, Joe Biden and his crew probably wrote that section for them. But yeah, so I mean, my real beef on this whole thing is about population growth and GDP per capita expectations, but we'll get that into in a minute.
Yeah, I mean, Keith, I guess the one silver lining here to give the government some credit, it was a lot of speculation that they were going to raise the top tax bracket. So they didn't. So you're in the clear there. But yeah, I mean, Rich, I don't know if you want to jump into that. There were some interesting comments from Scotiabank's economist there. He seems to be dunking on everybody. He was dunking on the Bank of Canada for a while. And he wrote this note here, I believe it was yesterday after the budget came out. So he said, in a broader public policy sense, Ottawa's housing strategy remains confusing. The Bank of Canada is trying to contain inflationary pressures and soften previously raging house prices. The feds have thrown open the immigration doors into a market with no supply, while another tax subsidy to housing starts up on Saturday in the form of a first-time home buyer tax-free home savings account that allows one to shelter up to $40,000 tax-free with annual contributions of $8,000. Housing is going to rip after a temporary retrenchment, and there goes the Bank of Canada's efforts. So, I mean, that was just part of his, but essentially saying that, it was an inflationary budget, essentially. I mean, they also provided a subsidy for groceries. So if you were a low to moderate income family, I think they were giving, if you had 2 children, it was just under $500. They were giving you single people getting a couple $100. So yeah, I don't know. I mean, we're at the point now where we're subsidizing groceries. Obviously, you don't want to feel bad or not feel bad, I should say. You don't want to not feel bad about, low income people affording food. But sorry to interrupt the show. Just wanted to let you guys know that this episode is sponsored by NordVPN. NordVPN now has a brand new feature called Threat Protection, which protects you from nerds like Rich who might run malicious websites and malware. Get hassle-free virus and threat protection and improve your digital experience. In simple terms, NordVPN is a one-click personal cybersecurity tool. In this crazy macro world that is moving at the speed of light, don't leave your personal online security to chance. Get NordVPN using a special promo code just for Loonie Hour listeners. Get your exclusive deal by going to nordvpn.com/Loonie Hour.
No, that's exactly right. But these people are decidedly not supply side economists, and no one who's ever studied the Chicago School of Economics or even knows who Milton Friedman is clearly works for this government. Because instead of subsidizing people, you could just cut taxes, right? It's something known as, it's there's that way to do it. But the other thing is on the inflation thing, I completely agree with what that gentleman said or lady said from the Scotiabank. But this is what we actually talked about this like 4 months ago, which is you can't have that much population growth and not have it affect basically the general inflation level. And so in the budget, there's projections on what interest rates are going to do. And basically on March, in the end of this month, interest rates are going to start falling in Canada and continue falling until they get back all the way back down to 2%. And the reason that's a dangerous game to play is because the interest payment on the debt, on the new debt, and all of the sort of the cascading effects of those lower interest rates are going to affect spending and projections and growth and this and that. And when you and I just don't buy any of that, just to put it mildly. So we'll see. I don't know, Keith, do you have anything on
Rich,
that?
to your point earlier on, so basically they are projecting, 2% real GDP growth?
Oh yeah, but
if your population is growing by 2.7%, which it did in 2022, maybe it doesn't grow that much again, but your population essentially is growing more than 2%. And so,
well, let's just use their numbers. Let's use their numbers, and I'll let you guys do the math. And so their real GDP growth projection from 2022, which is obviously past, to 2027 is 2%. Now, this includes the massive fill up in 2022, right? So it's a little bit overestimate, but whatever. And then on the next table, on table A1, which I referenced, their projections for real GDP growth are 2%. So 2 minus 2 equals 0. And so basically, the reason I'm laughing is because it's like normally when you're presenting a budget, you want it to be rosy. You want to tell people how amazing you are. We're investing in this. We're saving the whales here. We're giving this people there. But this budget tells Canadians in no uncertain terms. Again, this is supposed to be rosy, but this budget tells people in no uncertain terms that they're not going to be better off in 4 years from now. And that's an incredible indictment on their policies. And these are what they're telling us, you know? So you can only imagine that if things don't go as well as their projection, which they never do, that means we're basically going to be materially worse off in 4 or 5 years. And so that's the reason I'm laughing is because normally when you're presenting something, right, Steve, when you're trying to sell a house, you say, oh, no, it's not that loud over here. Or, you know, God love Keith. He's had a great couple of years, but, you know, he's not going to tell you there's a possibility for doing well. I'm the same way. Sure, I can predict the cycles. And yet their own projections are telling Canadians they're going to be poor over the next 5 years. And that's a remarkable, I think, admission.
Every listing I have is the best listing.
Yeah, exactly.
Keith, what do you think?
I just want to listen to you guys, but you're hitting it right on the head. And so what everyone needs to appreciate here, you know, you get the headline sound bites, and the sound bites, they're always nice to hear. I mean, you know, people should have access to dental care, for example. They're going to do that. More spending on healthcare for the provinces.
Clean technology.
I don't know if throwing more money for wages solves the healthcare problem. There's a lot of things going on there, however, but they're doing that. But what, you know, both you are pointing out here, and specifically Rich, you know, with the hard data, when you get into the specifics and the baseline numbers they're using for their projections, we could have some pretty big struggles coming up here in the country. And so notice I'm saying this with a calmer voice. I'm not talking about a big pile of crap or anything. It is a realistic perspective. And I mean, so for example, if you just listen to it, let's make it real simple. We're budgeting higher deficits for the rest of this term. What's the projection for 7-8 years out? 6 years,
2027.
Okay. So every year you have more deficits or a little bit less. And by the way, the deficit number, that's just like a goal seek function on your Excel spreadsheet. That's all of it. So many factors can go in to move that around. But if you have bigger deficits every year, guess what that leads to?
More debt?
Yeah,
Higher
bigger
taxes.
piles of debt. Yeah, absolutely. Bigger piles of debt. If you have bigger piles of debt piling up, then you got to service that debt. And so I think one of the numbers that I saw from one of the studies with this, at current rates, the interest expense is going to be about 10% of current tax revenues coming in. So think about that for a moment. 10% is just going to pay interest on this. We're back to this big pile of.
Rich, what's the projected interest rate though? Because that's also like an unknown variable as well.
Well, I mean, that's used on that's from economist expectations and the yield curve. Obviously, I'm a contrarian when it comes to this view. I think interest rates are going to stay either at their same levels or even go higher over the next 5 years. All of the projections, I'm certain, have them going down. So the bond rates are down at 3% or whatever for 10 years and etc.
So that's going to be an important variable, right? Just figuring out what happens with inflation and interest rates, because that's going to move these numbers around.
Yeah, it absolutely is. So I mean, along this theme, we're getting bigger this, higher this, and more taxes and stuff. So eventually it could create this situation which we introduced earlier, where there's not enough tax revenues around to even control this deficit spending that's happening. And it doesn't matter who's in power at the time. So, and obviously the Liberals and the NDP partners came out with this budget. And this could very easily flip to another party, very soon. And then, you know what, they could have a very similar, response to it, because it's hard when you're dealing with this, and it's irrelevant, how it was created or why it is there. But in Canada, we could very quickly and suddenly find ourselves in this situation where it is becoming out of control, or it's uncontrollable. And then that gets reflected then in equity market prices, the Canadian dollar, the bond market, and so forth. And then the moment that we're not able to attract foreign capital at that because of what's happening, that's when we do run into this slippery slope again. And because you guys may not remember too much, but back in the early O's, I mean, the Canadian dollar was headed to 50 cents. Like, that's where it was going. And at peak amount of fear, that's when it actually stabilized. And the government at the time, I think it was the Liberals back then. I think it was
Paul Martin.
Yeah. And, they came out and they said, you know what, this is what we're going to do. We're going to start paying off the debt. And it did turn things around. So it is, you can right the ship. But as it stands right now, I mean, trying to sell this as a prudent budget, I mean, that's tough. So let's go down through the whole prudent aspect. It's really two prongs they're looking at, or two sides. One is the healthcare perspective, and we'll leave that as it is, because that's such a tough challenge to solve. It has to be, or it would have been solved already. And then they're going with these clean tech subsidies, because I know, Steve, you referenced, to Biden's team maybe writing some of that comment in the budget. Or was it Rich? Was it? Okay.
Because he's got, because Biden called it the Inflation Reduction Act, but it had nothing to do with inflation. It was basically just a bunch of subsidies for.
Yeah, absolutely. I mean, the whole idea behind, for people if they don't understand it, and I can't get my head around it as well. But they want to provide subsidies to the private sector, as well as some public sector entities or organizations, to define, greener solutions, for our environment. And because you usually don't make money on that in the initial startup period, the concept or the theory is that, hey, government has to help that industry move along, and then that will provide some really great, long-term investment, and then it will pay off, down the road. That's the reasoning behind it. And so that's one of the biggest, reasons for going in this direction. One question I'll put out there, for you guys and everyone else, like, what if that's the wrong strategy? What if the strategy for a clean environment is actually to leaving it to the private sector, to figure out? And we can talk about that another day. But the American energy sector, their data metrics that they've been, producing over the last decade, they're becoming cleaner and more efficient than ever before. They're doing it. And obviously some people say, well, they're being forced to, because of government, stuff like that. But the point is, they are doing it. But we're going down this sort of wacky road here right now, where it could create this moment. And we have to talk about the Bank of Canada's potential response as well.
Well, yeah. So, I mean, I think the overarching theme here essentially is, again, it doesn't matter what your political stripes are, or your views, or how you're going to interpret this budget. The overarching theme here is that the level of government, and Canada is not alone, but all of these governments are accumulating massive debt burdens, trying to sort of keep the system propped up, trying to keep, the voter base happy, and nobody wants to sort of go through any sort of difficult times, right? I mean, like I said, you've got the Bank of Canada raising rates to fight inflation, and the government's response is, well, why don't we start mailing people checks to help, this inflation pain? But that's not going to be the remedy. It's just going to create even more.
Yeah, it's counterproductive.
Exactly. And so I just think, like, bigger picture here is the moral of the story is basically governments are digging themselves deeper and deeper into a hole. And again, it's not just the Canadian federal government. I'm sitting here sifting through Twitter, and there was someone sent me about the the city of Toronto. demanding Canada to bail the city out of its $1.5 billion budget hole. It's basically saying that if Toronto fails, Canada fails. So they want some help now from the federal government. And
well, in some ways, there's probably some truth with that.
Yeah, I was gonna say the same thing.
So instead of
Not
asking me
wrong.
bailed out, maybe you just let it happen. And then
but there's no responsible people in the room.
But I mean,
Yeah.
Toronto is overwhelmingly probably the most productive part of Canada, whether we like it or not. I mean, them, a couple of cities in northern Alberta. I mean, you know what I mean? Cities are extremely, extremely productive. They probably pay an incredible amount of taxes already. I would imagine, you know, yeah. So there's definitely some truth to that. And although I agree with you that cities should probably be more careful fiscally, it's not necessarily a bad idea that we help the largest economy in Canada.
I don't know. I don't have the I don't have the number in front of me, but I remember reading it maybe a month or two ago. Someone had shared it, the research note to me about the amount of tax revenues the city of Toronto collects from the real estate sector.
Yeah,
and I think it accounted for like 20-25% or so. It was an outrageous number basically. So kind of like, I don't know, it's interesting. It kind of makes you think. It's like government says they want affordable housing, but they kind of need to keep the wheel churning. Like they can't really have prices fall.
But that's what I mean. I think one of our first weeks ever doing the Loonie Hour podcast, I made that point, which is I submit to you that no government wants affordable housing because that means the prices of the houses of their constituents is going down relative to their income. And no one's going to vote you back into office if their house prices are going down. And so, you know, I think, and that's why I think we're as voters, I think we are sort of responsible for a lot of the shit, basically the shit sandwich that we're sort of eating right now.
Yeah,
I mean, no one
see obviously like the
it's one thing
younger
to
voter
blame
base.
Right, but it's one thing to blame Justin Trudeau for like not being fiscally prudent, but it's also up for us, for the voters, to reward politicians that say they want to be fiscally prudent for all the following reasons. It's not. We got to take some responsibility. You got to take some responsibility for what's going on.
That's an unacceptable view, man. Come on. Coming back here though, again, like I've been negative on this budget, and so we have unsustainable debt growth. Debt growth is happening right now, and if we do get a recession, then it's big trouble coming down the line. Or if rates rise, and it doesn't mean the Bank of Canada overnight rate. If the yield curve shifts, or maybe the government, the yield curve for federal government that stays flat, but spreads shift. So maybe the Canadian yield curve increases relative to the American curve. Like there's so many things here right now, and like if three of us were in charge on how to fix this. The famous joke, of course, is the first thing you do, you'd quit. It's I don't know how this is resolved, because it goes back to, the solutions being offered today are in reaction to the bad solutions that were offered during the COVID pandemic response. I mean, that's all it is. That's why, we have inflation just raging around the world right now. It all swirls back to that same decision on day one. And now we're giving a family like $500 to help offset food prices. And at the same time, you're going to make food more expensive longer term. I mean, again, like none of these things make sense. So
Keith, you chatted about, government revenues. Basically, we think that those might be potentially optimistic, assuming you enter into some depth of a recession. How are things evolving in your opinion on the global macro side of things? We're seeing these banking crises. There was a good chart from Jim Bianco there on Twitter the other day, which is still showing that still a lot of deposit outflows in these U.S. banks. So the issue, I don't think, has necessarily gone away. It feels like contagion may be sort of resolved for now. But you know, how are you looking at things right now in financial markets?
Yeah, it's so the quick answer is funding stress in funding markets, they've improved significantly over the last week. So so let's just back up a second. The narrative that we're looking at now is that over the last, let's call it 5 months, we've had 3 significant crises in the financial world. So we had the British pension fund gilt crisis. Then we had the Silicon Valley Bank crisis, and then Credit Suisse. So 3, if either one of those on their own had potential to just go kaboom, in the world, that's what would have happened. However, the response from either regulators and policymakers was extremely quick, and especially with the Americans, it was very global. So there was no contagion really from those 3 events. I mean, obviously some folks got hurt out there, but overall they contained it. And that's really great news, guys, because I think 5 years ago, 10 years ago, it wouldn't have happened. They would have just let it blowing up and, see what happened and then, try to respond to it. So we have that happening. So that is good. And conditions have improved over the last week or so. Right now, markets are basically, hey, risk on again. Obviously, we're coming to quarter end. So this is Thursday the 30th. Tomorrow's Friday the 31st. End of the quarter. So there's lots of window dressing taking place. But something else really interesting happened last Friday. I want to share that with everyone because these risks are still out there. And it's because something's out there doesn't mean it has to happen. But if it does happen, eventually the Fed and everyone else, they won't be able to react as quickly and as cleanly as they did. So when we had the Credit Suisse event taking place, the U.S. Federal Reserve, they opened their swap lines for all central banks that they're friendly with. And they open it up, max, whatever you need to take, you would take. At the Fed, they also have a new credit line, if you want to call it that. I think it's FEMA, so it's FIMA, Foxtrot, India, Mike, Alpha, if you're into the alpha words. That's meant for countries who do not have access to swap lines, and the maximum you can draw on it is 60 billion, right? So when you draw on one of these swap lines or this new FEMA one, you need to post collateral. And collateral in that world is treasury bonds. That's what you're looking at. You get a 1-for-1, coverage with it. So then you start looking around. Okay, who has at least 100 billion available in T-bills or T-bonds? They can use to post collateral for that, and it very quickly eliminates a lot of the people who would be doing it. So with my friends in the industry, we're all having this great nerdy conversation this week. So who took it? Who took the 60 billion? Some people think the Swiss did it, which I find unlikely because they can use the swap lines anyway. And then another group says, no, it was the Chinese. China took the money. And because they're the ones with enough collateral in order to do it. That took place on Friday afternoon. And then, so, if there's something bad going to happen, you survive during the week. And then you got to, hey, make sure you shore things up over the weekend. On Sunday night, when the Hong Kong dollar currency opened for trading, it immediately broke through the peg. And it was through the peg for more than a couple of minutes. And then they finally got it under control. And now every day, this is 4 days straight now. It's been up against the upper range of the ceiling here every day this week. So it's highly likely that the Chinese needed USD cash. So just because you have treasuries, it doesn't mean you have US dollars cash. You have treasuries. Because the old story is, next time you guys go to the store to buy something, instead of using money, ask the clerk, hey, can I give you a T-bill instead? And they'll laugh at you. Right? You need,
they won't laugh at you. They're gonna look at you like they have no idea what you're talking about.
Yeah,
use my check from the CRA, free groceries.
Right. So, Rich, maybe that's not a pickup line to use.
No,
maybe that's not. Yeah, you wouldn't have any success with that one. But back to this story. If it was China who needed the 60 billion, and again, it looks like it was, it's an incredibly significant story that's been developing this week, because for China to have to draw 60 billion from the New York Fed to help with capital outflows out of Hong Kong, which is the conduit for China. It means that there's something serious going wrong there. There's capital just oozing out of the system. Also, what's happening, if you follow the Hong Kong dollar peg, whenever it reaches that high level of the band, it's there for a day, the next morning, they announce how much they've drawn down on the liquid reserves. And the liquid reserves right now, it's about 55, 60 billion Hong Kong dollars, which is about 6 billion USD. Is not a lot of money. So that's the story that's creeping out there right now. And as we go into another weekend and the quarter is over, if you come back to you wondering, hey, what might happen next? You really want to focus on the China-Hong Kong story, as well as another story that we introduced a couple of weeks ago. Remember the Japanese story we talked about?
Yeah.
I
guess so. No, I don't remember.
I don't remember.
I don't listen to you when you talk. I don't listen to you when you talk, Keith.
I know people don't realize when we're doing this on the Zoom. Whoever's talking, the other two just put it on mute, and then they're just like playing with their Tetris game or something. But a couple of weeks ago, we introduced the potential storyline or risk that's out there that if in Japan right now with the new Bank of Japan governor. If they start to raise rates or allow rates to go higher, it's going to give the opportunity for like gobs of Japanese capital to repatriate it back into the country. And that, of course, so when you take foreign capital out of one country and it goes somewhere else, it creates a lot of, and the Japanese have just they've been stuffing their excess savings everywhere outside of Japan now for 20 plus years. And one of the guys on Twitter shared the story with us earlier. I don't remember the gentleman's name, but thank you, Mr. Gentleman. But Bloomberg picked up on this story as well, and they wrote a really cool article about it. So again, it's another one of these risks that are out there. In the article, it highlights, which countries could lose the most capital out of their system and so forth. And Europe is, that's a pretty big market to look at. So Steve, to answer your question, from a global macro perspective, things have stabilized quite a bit, but we have these other sudden stories out there right now. And at some point we'll find out, who took the 60 billion. If it wasn't the Chinese and it was someone else, then, we'll have to talk about it then. But it's a pretty big story in my world.
So yeah, not the all clear. It looks like there was and again, Rich, I'm kind of curious how you interpret this, but another explosion in Fed liquidity. So we've injected about $434 billion into the system. So we've raced about 11 months worth of QT, quantitative tightening. Again, perhaps a one-time liquidity injection given the banking issues that were, emerging. But, I'm kind of curious, how you're looking at this as well.
Well, I think there's a difference between liquidity and solvency. And I think what we've been dealing with over the last few weeks has been a liquidity issue. The reason I bring up the solvency stuff is because in 2008, 9, or whatever, there was a solvency issue. All that equity across the banking sector in the United States was virtually wiped out. And the quantitative easing and all of the basically policies, whether it was TARP, it was this or that, whatever, it was in order to recapitalize those banks and banking sector and a bunch of companies that were related to that. Those banks were insolvent and they needed to make them solvent. And a lot of the policies around that were basically to do that either by stealth or because that's not how people sort of saw it. But in my view, that's sort of that was the problem we had there. What we're dealing with now, in my view, again, as someone who's maybe takes a rosier side of this banking sector issue, is a liquidity issue. And I think that's exactly what the discount window is at the Fed for. It is in order to prevent a liquidity issue from becoming a solvency issue. And that we've seen that happen. So Keith made the point that, this time around they stepped in. We know in the past that they haven't, whether it was in 2008 or 9, whether it was an issue in 2012 and 14 with the European crisis. A lot of those, you could make the case that a lot of those European countries are insolvent, but just, bear with me for a second. At the time, it was a liquidity issue. And if you could provide that liquidity, then, you can weather the storm, so to speak, and move on. And I don't like the conflating those two. I think that's sort of missing the point. I think I will be proven right or wrong in 3 or 4 weeks, or maybe a month, or maybe 3 months when we see the number that's at the discount rate window that has been drawn go back to zero, right? Because that's the way that chart looks. And I promise I will share it on my Substack this time. When you have it basically is 0, 0, 0, then it spikes up to 120 and it stays there for 3 weeks and then it goes back down. And then that's the point of the Federal Reserve. That is, I know it's scary and I know there's lots of big numbers being thrown around on Twitter, but that is the function, like that's your job description. And so that's sort of my piece on that. I think on the global macro stuff, I think that the equity market seems to be very happy. I think, themes that we talked about over the last, year or two, which is the growth versus value, the tech stuff. I mean, I'm getting hammered on my short tech trade. It's the best performing sector this year, which kind of hurts, but we'll see. I think that sort of belies a lot of the things that are sort of going on under the hood, which is rolling margins that are rolling over, sales growth is slowing. If you look at some of the business confidence indicators, yes, that they've popped since, the energy crisis that we saw in Europe, but they're still very, very low in China. The ISM is still below 50 in the US. Consumer confidence, which had a sort of a rebound, is sort of stalling out a little bit. There's a lot of the sentiment and technical indicators that have done well, as Keith pointed out, which is, we talk about the MOVE index, we talk about European bank stress, that's okay. But bond spreads, corporate bond spreads haven't had the move, let's say, in positive territories. They haven't come in, they haven't softened, haven't gone lower, even as the equity market is, is popped 4,000 and seems to be rising. I don't know what's going on today, but having another half decent day today, the credit spreads haven't come in. And so you sort of, not to overly complicate things, but I think on the surface, there's lots of really good stuff. But I think, you just scratch that a little bit. And I would say that there's still, there's still some negative news out there, but I don't know. I think that the other thing I would say is that the 10-year bond yield hasn't really risen. And that's normally the sort of the big vote of confidence, right? That's an important indicator as well.
With you just mentioned, credit spreads haven't come down too much. Sort of, Steve, have you seen a change with mortgage rates across the curve?
Yeah, that's a really good point. I've been following them extremely closely. I'm actually about to do an equity takeout. So my construction project in Calgary is basically finished. So anyone that's been following along there, we did a small multifamily project. So yeah, so I've been watching rates literally every day. And despite the large downwards movement in bond yields, the banks have really not cut mortgage rates at all. 5, maybe 10 basis points. But considering the move in bond yields, so it tells me that obviously banks are being conservative. They're baking in that risk premium, probably trying to squeeze higher interest margins. And so that's kind of where we're at right now is banks. There's a couple Canadian banks I can tell you that are almost out of the mortgage business, where they were like huge. I'm not going to name the bank, but huge players during the pandemic, handing out loans hand over fist to these investors. They've completely pulled back. Their rates are 50, 60 basis points higher than any other Canadian bank, and they don't want the mortgage business at all.
That's really interesting. Because if you measure, like, what one credit spread that we would look at would be triple Bs over investment grade, right? And like as Rich said, like it's not tightening. By the way, when we say tightening, it means that's better. That means more people want credit, like they're willing to buy that credit. And I always view mortgages as, as kind of simplistic, but, I'm a simple guy, right, Rich? I take things that way. Yeah.
Simple guy who likes his Pinot.
It's such a beautiful wine. It's complicated and it needs to be in the exact right climate. Where was I? But with I view mortgage rates as basically it is a play on credit spreads. It's just in the consumer housing market. So it'll be interesting once again when we get the Canadian banks with their earnings coming out to see what they're doing on their provision for credit losses. And that's where we're going. End of quarter, like in my world, is always big because usually people are scrambling to have something on or off their books at quarter end. And so we'll see how we're looking here heading into
just to summarize, to kind of wrap it up. I mean, you're cautious. things may have settled down a little bit, but underneath the hood, there's still quite a few underlying issues, and it's sort of caution ahead.
Well, this is going down through our this path that we always talk about. We thought equities would come down in Q1 into Q2, and it's trading sideways at best, so that makes sense. It was our expectations for commodities to come down in this same time frame. And those are clients of ours that they know that we've been adding to 2 different commodity markets over the last few weeks. Once we're finished with that, we'll share with everyone here on the podcast what we've been doing, and that's moving in that direction. So we haven't been surprised with where we are. The one surprise, and it's a compliment to the central banks, maybe it's a backhanded compliment, but that they have been able to contain or prevent contagion, from all these, major risks that have developed. I'll say it's a backhanded compliment because in many ways, they're the ones that created the environment for these, risks to develop in the first place.
Almost,
but, hey, that's
almost a compliment for our buddy Tiff there. Almost.
Can I add a couple of things? I think it's also important to note sort of that, the market, I'm looking at the chart right now, and the S&P 500 has, in Q2 of 2022 was at 4,000, and we're at 4,064. So, you've had 1, 2, 3, 4 quarters. I can do math. 4 quarters basically with an incredible amount of volatility and virtually no return. And I think it's sort of, we're touching on something we talked about maybe a year and a bit ago, which is, you're in an environment where the cost of capital was free, and you're now in a world where cost of capital is something. I don't know. I don't know what it is. We're still trying to figure out what that spread is, or what the neutral rate of interest rates will be, what we think the terminal Fed funds rate will be. It's just whatever that number is, it's not zero anymore. And it's not deeply, deeply negative in real terms anymore. And I think that whole process, will perpetuate what we've been going through, which is you have to, everyone's goal seek models, whether you're private equity, whether you're an investment manager, whether you're a single stock, like bottom up guy or girl, your entire your interest rate is now different, and you have to assess what is going on and how to discount all those future cash flows in your little NPV, your net present value calculator, to see what that stock price is, what the S&P 500 should be, and whatever. And it also changes what people are willing to pay on a multiple. So your terminal multiple has also changed, right? When interest rates are zero, your terminal multiple can be very, very high, and vice versa. And it's a little bit circular, but the point is in a world with low earnings growth, because earnings growth at the index level have been flat now for almost 18 months, and you could make the case they might fall. Let's just say, for argument's sake, they'll be everything is about this interest rate, and everything is and the fulcrum on which the entire world is shifting, because you have no earnings, is just what that discount rate is. And until we get some kind of visibility on improving earnings, or at least margins that stop falling, I'm going to remain negative and remain defensive and remain cautious until you get some visibility on earnings, because to me, I don't like playing the interest rate game. It's not a calm, I'm a economic growth, earnings growth, multiple contraction, someone who likes to chase that multiple contraction on better earnings growth. And right now, really what we're just seeing is just the manifestation of that new paradigm where cost of capital is something in a world with no real earnings. And that's a dangerous game to be super bullish on and ballsy on. I don't know. That's sort of the way I sort of see it.
No, I think that's a good place to wrap it up. As always, guys, we appreciate the support behind the scenes here. We are working on some event details for a live event in Vancouver this summer. Come enjoy the Vancouver sunshine. And we're also going to try to do a Calgary tour as well. So we'll kind of do almost like a back-to-back Vancouver, Calgary sometime this summer. Still working on the details, so stay tuned for that. If you have any sort of comments, suggestions, advice, always send us an email, comment on the YouTube channel, what have you. But we appreciate your support, and we'll see you next week.